I want to learn about what's important to you. I want to learn what your pain points are, especially if you've used a cap intro specialist in the past. What happened? What went wrong? How can I address that?
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. He's a dynamic alternative investment lawyer and private placement consultant. He thrives in the global private markets as a partner at FisherBroyles LLP and CEO of Arche Investments. He expertly navigates the challenges faced by the investment community. We're going to be talking about a lot about that today with an innovative mindset. He combines legal expertise and capital introductions and influence and strategies to fuel success in niche alternative investments. Please welcome my next guest, the one and only CEO of Arche Investments, Jamil French. How you doing today, Jamil?
Hi, Christian. I'm great. Thanks so much for the opportunity to speak to your audience.
Man, I'm looking forward to this conversation. And one of the things that I found interesting about your kind of aspect is you have not only law experience, but also alternative investing experience.
Yes.
Which I found very interesting because when you're working with these family offices and high net worth and ultra high net worth, naturally they're looking to deploying capital and facilitating their whole portfolio. So first of all, Jamil, when you were being in law, what made you decide to get into this vertical as well and run both vehicles, and how has that been effective?
Sure. No, it's a great question. And, I found that at a certain part of my career, I was looking for something more than what I was currently doing. I had been a transactional lawyer my entire career at that point, working on Wall Street and working in investment banks and with law firms and even in-house at a hedge fund. But it wasn't until I found myself in Orlando working for a large institutional firm that I discovered that there was something more that I wanted to be. And it actually came down to an opportunity that slipped through the cracks to join a private equity firm in New York in-house. And I put a lot of work and blood, sweat, and tears into ingratiating myself with the principal and his extended family. And when it came down to talk compensation, I was quickly reminded that I was just a lawyer and that my compensation would be reflective of that. And so it was definitely a letdown, but Christian, what it taught me was that, unless I made some changes and some additions into my tool belt, I was always going to be just a lawyer to a lot of folks in this world. And that if I wanted to get into certain rooms that I couldn't as a lawyer, if I wanted to have compensation that reflected what a principal gets in some of these deals, that I was going to have to expand what I do and reframe how people see me. And that's when I began my journey towards becoming a private placement agent and combining that with the legal work that I do.
Which I found so interesting. That's one of the reasons why I want to have you on our podcast, because I've had some that just focus on legal aspect, which is cool, but you kind of have gravitate toward both.
Yeah.
Now, when you're working with your clients, naturally they come to you in regards to legal purposes and legal questions. What is that? How do you establish that kind of comfortable bridge to talking about other alternative investing? Because I would imagine some of these individuals, they're looking at building, very specific trust or other questions about navigating their wealth, et cetera, et cetera. And I would imagine that's kind of an easy evolution. But how do you bridge that gap to talk about some of the deal flow and the alternative investments that you do have access to?
Sure. Well, as you can imagine, both of those worlds are very cross-pollinating. They play in the same sandbox, so to speak. So it's very easy to get cross referrals from one side of the business to the other. But I think you're right in highlighting that it can be a bit challenging, and especially from a legal ethics point of view, I have to be very careful about how I work with clients and how I get compensated from clients. And so I have made a choice to ask folks to kind of choose their own adventure when we speak. And if they would like more legal work, then I have a platform for that. And if they would like more cap intro work, I have a different platform for that. And so I do not work with one client doing the same types of work, both types of work. It's just a little too tricky. And so I think most clients respect that because they do want your full attention and your full, your full attention and your full care on what they're doing. But in either case, I think folks appreciate that I bring a legal mindset to the cap intro work that I do, and that I also bring a marketing, IR, and fundraising aspect to the legal clients that I serve. Even if I'm only representing them on one side of the business or other, I think they really do appreciate that someone's coming to the table who understands the deals, who's not going to make them any trickier or harder than they have to be, and who could help them kind of think through some things from a different perspective that they're perhaps not getting elsewhere.
Yeah, that makes sense. And it sounds like you're a connector in both ways, right? For those that are looking to deploy capital into maybe, certain kind of, investment deal flow. And then as well as those that you're connecting with in regards to founders that are looking for capital. So it's really nice. I'm curious, how do you structure that, those conversations, those dialogues in regards to who do you work with? First question, who do you work with? Because everybody now with the macroeconomy going on and the ups and downs and the booms and busts, people are looking to raise capital, and it's a tough macroeconomy. Obviously, it's not going to last forever, and maybe 2 or 3 years before things start, getting back,
Right.
get all, oiled up again. But my question is how do you determine your methodology or criteria to determine what founder you're going to work with and what company or what deal flow you're going to help in regards to leveraging your Rolodex and your network?
Sure. No, that's a great question. And I always, whether it's the legal work or whether it's the cap intro work, I try to identify those clients who, quite frankly, are a good fit. And by good fit, I mean, number one, are they above board? Meaning, do they get what the business is about? Are their hands clean, and are they able to work with you, in a forward-moving way? That's kind of the first thing you really want to look for there. And not everyone's at that stage, and it's okay. But we tend to like clients who have been in the business for a while, and who we prefer teams because there's some redundancy there. There's some institutional knowledge, meaning like internal knowledge that they can share with each other, and it just presents better to the outside world. I would say on the cap intro side, I typically work with funds who have assets under management somewhere between 50 million and 300 million. And it's a rough range, but that's typically in the sweet spot, because below 50 million, they may not be able to, afford the commissions and the cash flows that are required to pay a broker. And above 300 million, they may already have someone internally to do that, or they may not need your assistance. So I'd say, that range tends to be a very good spot for working with folks. But to your point, emerging managers are finding it harder and harder to attract capital these days. And so part of the screening process is understanding whether this particular client has a strategy or a product that really does something that no one else does, and a team behind it and a principle behind it that can really attract the attention of skittish investors.
Are you stage specific in regards to kind of the founders that you work with in regards to your deal flow?
Sure. I have found in my experience that although very enticing and very energetic, earlier stage like seed stage and founder stage companies really don't have a lot of traction in the marketplace. I have colleagues who specialize in that space. They are very good in that space because they have the unique skill set and connections for folks who want that. I typically work with, earlier stage companies that are probably, round B and above. And later, I should say. And I also work with later stage companies that are pre-IPO who are looking to help investors come in and out of their companies on a kind of a late stage unicorn basis. We call those late stage secondaries. And that tends to be where I am on the direct deal side. On the fund side, it's going to be always a question of, does the strategy make sense? And funds, especially hedge funds, have had lagging, kind of middling performance, relative to the rest of the S&P. And it's a lot harder. Quite frankly, it's a lot harder to showcase those fund managers. So what you really want to set expectations with your client from the beginning about what the market's capable of. And you don't want folks to be disappointed at the end. They need to understand these are not the best market conditions. Your particular alternative asset is not terribly popular right now. Typically a range of time to market would be anywhere from 6 months on the low end to 24 months on the high end. Those ranges might even be extended these days. So it's definitely necessary to communicate with prospects beforehand and give them a full picture of what we think we can do for them, so that there's a good understanding going forward.
Do you, when you're looking at, and I appreciate that, so you work with a lot of founders, pre-seed to Series A probably, nothing in between, and then later stage, which they're already probably, pre-IPO, they're billion-dollar companies, so they obviously got proof of concept, established development team, and so forth. And those are more secondary, so I definitely understand where you're coming from on that. In both of those verticals, do you find that you try to stay in to a specific niche, because in those specific verticals there's tons of different, like deep tech, there's generative AI, there's biotech, there's all sorts of different strategies and things like that. So where do you gravitate toward? Because obviously a lot of your investors and the connections that you have, I would imagine they all have their very specific investment thesis.
They do, and to that point, I think one of the awakenings, let's call it, that I've had later is that in many cases, even though I may work for the company looking for capital, in many cases it's better to start from the premise of what are the investors with whom I have the best relationships looking for, and go that route, and then help them find and identify a company that might make sense for them, and then approach that company to work with on that basis. It's much more targeted, and it definitely takes longer. But I think you're at a greater advantage that way than working with an array of companies for whom you don't know whether there is market interest.
No, it makes sense on a conversion and a sales point. It's like, hey, what do you want? Go find it, and I'll give it to you, right? And it's just an easier conversion that way. So that definitely does make sense. So in regards to that, I know obviously this will change, and this answer will probably change depending upon obviously the environment. But I'm curious, the heartbeat of where a lot of people are at. I've known a lot of family offices. I know a lot of high net worth individuals, and they're all kind of sitting on capital right now, just because of the macroeconomy, the ups and downs. They're just not sure. But there are still deals being done. Maybe it's just drastically decreased, but there are still deals being done. My question is what are you noticing? Where are you noticing a lot of the deals, the excitement, the fun things? I got a few topics that I've noticed, but I'd love to get your perspective. What are you noticing in regards to your Rolodex that they're excited for, that they're kind of really got head of top of mind and they're focused on?
Sure. It's I don't want to consistently sound pessimistic, but a lot of venture capital firms and other LPs are really kind of reserving that powder because for a bunch of reasons. One is inflation and the economic environment and the global macro environment with wars and political instability has pulled a lot of folks back. A lot of folks don't want to have to pay the sunk costs of developing relationships with new companies. They'd rather just take that money and deploy it into existing deals. And so, you asked me what deals am I seeing excitement around. Quite frankly, I think folks are happy to take a single or a double with someone that they know than a triple or a home run with someone that they don't know. I think that's kind of the philosophy these days. But in terms of spaces that are getting talked about, energy storage alternatives. I have folks who have asked me about those kind of deals. Depending on where they're coming from, certain real estate deals, especially if they're more trophy minded, might capture the attention of certain audiences who like those deals. I think real estate's always going to have a place for some people in the world. But sitting here in Miami, that's real estate is king here, and so there's always going to be a receptive audience for those things. I have not yet, and this is just where I'm sitting. I have not yet heard of a rush for folks getting into AI. I have certainly seen deals, but it's not a bonanza at this point. I think folks are still trying to see where the market sorts out in terms of players and capacity. Cannabis-related deals are still being done. I think folks have gotten over their initial skittishness about working with deals that are directly touching the plant, especially as more states come online for medical and recreational use. And the ecosystem around that space, delivery, other facilitating industries certainly have deals that are still being into. And just as a side note, the pet-related market, pet supplies, pet technology. There's a huge opportunity there, and I have seen an uptick in the number of deals around that, whether it's doggy doors or distribution networks for food, other things that are on a subscription service, because people will pay lots of money to take care of their furry kids. So I think that's something that's worth highlighting.
Now that is interesting. Just on a side note, I'm astounded by how much people spend on their dogs and their pets, and I'm talking insurance, talking toys, talking just subscription things, and all sorts of stuff. So that is a very very competitive market, but very interesting.
Mm-hmm.
Now, in regards to what you're looking for, I've talked to some family offices. I always find it so interesting. Every individual, like I mentioned, like you said as well, the investment thesis is drastically different. Some gravitate more toward funds because they rely on that team or their experience in regards to underwriting deals, etc. So they kind of trust that, they lean on that or their expertise. Or there's more direct deals, right? And I see a lot of people that are very familiar with real estate. They have more of a direct deal and syndication and so forth, and take more of an active role in it. What are you noticing? Do you see like a trend in regards to people going from funds to more direct deals, or vice versa in regards to the clients and the Rolodex you have?
I don't really see a trend per se. In my experience, investors have their preferences more or less defined. They're either solely in one camp or the other, or they want a specific dedicated mix of the two. And so I don't see a lot of folks kind of running from one camp to the other. Usually, especially the larger family offices and certainly the institutional investors, they have a portfolio requirement, like a mandate for how much they want to allocate to any particular asset class or subset of asset classes. And they may make adjustments to that, on the margins here or there. But there are not wide swings between those two. And quite frankly, I would be a little interested if someone was doing that, because it would suggest that they haven't quite figured out what they really want to be in. Those are different types of investments, and they take a lot of time to scale up and understand. So I don't see that really happening.
Okay, gotcha. So when you're have a client that normally invests into funds, do you maybe share a direct deal and saying, hey, I know your guys' situation, I know what this looks like, I know your goals, almost just an advisor, but not an advisor, but just coming alongside as a friend, being able to say, hey, this may be a good deal that aligns with your thesis, but it's kind of a direct approach more so than a fund, and it goes out of their kind of investment thesis. Do you ever have that conversation, or not really? It's like, hey, this is it. They're very kind of concrete in regards to their approach, and they've been doing it for X amount of years, and you just kind of stay with that.
You used the right word, which is advisor. I do see myself in that role, and part of that role is sitting down with someone from the beginning, understanding what their needs are, not only from a portfolio allocation perspective, but if you're dealing with a family office or a high net worth, there may be larger issues that they're dealing with that need to be addressed, such as succession issues, younger folks wanting more ESG type opportunities. That's the time and the moment to talk to them about what all they are interested in now and what they might be open to in the future. And surprisingly, a lot of folks will say, "Well, show me what you have." That there may not be any interest behind it. I think many of investors are opportunistic. They won't just say no to looking at something, but they get tons of proposals every day. And you don't want to be a burden at the same. So if you're going to put something in front of them, you've really got to make sure it matches, what they will do. And you've got to find a way to break through the noise, and you've got to be very careful about what you put in front of folks.
Yeah, it's because they're so different. It is based on relationships, and like I've got a few family offices. They do not invest in the first or second fund. Mm-hmm. They focus only on third and beyond. Mm-hmm. That just verifies, and it doesn't matter if they're VC or other funds or whatever approach that it is. That's just kind of one of their rules, which I found very interesting. But I learned that very quickly. So anytime I send a deal, now I want to talk a little bit about secondaries. I had a friend of mine. And obviously we're seeing a discrepancy in the price and valuation of these companies. Mm-hmm. And some of these, buyers and sellers, right? The valuation was $100 per share, maybe $8, coming on about 9 months ago now. And now it's kind of coming down to like, and I heard one person told me it was like $30 a share. That's a huge, massive discrepancy between the buyer and the seller.
Yes.
And so it used to be a seller's market where, hey, I could price it at this, and guess what? People are going to be buying that just because it is. Now it's more of a buyer's market, which is always fun, right? And but I'm curious, when you're working with these individuals, these buyers and sellers, right? Naturally, the cost of the share is only $26 right now, right? The valuation of the company drastically decreased. It's not worth 110, and so naturally there's this negotiation back and forth, right? And how do you navigate that between the buyer and the seller, definitely in this macroeconomy that has kind of disrupted a little bit in regards to that relationship?
Yeah, it's tough. Most of the secondaries transactions that I've been involved with, there is a buyer's rep and there's a seller's rep, and they are not the same person. Occasionally, I will be both buyer and seller rep, but typically you're working with someone else. And so that's the first divide that you have to kind of get across, that someone else is working with them. And how does that work? And especially with regard to brokerage commissions. But the other thing you have to think about is, to your point, a lot of the buyer reluctance, I'd say, over the last 2 years has been about these valuations. And typically what I've seen is both buyer and seller start from really polarized price per share points, really polarized. And it can be very difficult to move them off of those. And so what you used to be left with was this huge chasm that couldn't be filled, and therefore those deals kind of just didn't go anywhere. What I have tried to do is to talk with the person that I'm representing and try to get them to understand that this is just the first salvo is just the first salvo, that we can get to a point that's helpful, but we have to keep going, and we have to keep going quick, quite frankly, because that market moves fairly quickly. And so I think at the end of the day, it's still a challenge. It's less of a challenge than it used to be. But what you have to do is stay engaged, work with the other party's broker rep if there is one, and try to keep the deal alive as long as you can. And occasionally you get there.
Yeah, so do you find in regards to timeline, like you mentioned, there are some that the discrepancy or the margins are drastically different between the buyer and the seller, that nobody wants to move, nobody wants to negotiate. Do you feel like the seller at some point will say, okay, I see that the valuation has gone down, I'm just going to have to take a huge haircut on this price, and yeah, it's going to hurt, but at the end of the day, the sellers have to embrace kind of the market equivalent of what's happening. Do you see that happening, or do you think there's going to be just kind of stagnation for now until the market kind of embraces the true valuation of these companies?
That's hard to say. I mean, I can tell you, I think Preqin put out something earlier that said that secondaries, in terms of secondaries funds, are actually doing better in the last couple of years than they have since the years after the 2008 crash. We'll see if those trends continue. What I have typically seen is when buyers, and this goes back to earlier, the last couple of years, when buyers are supercharged about something, they will meet what the seller wants pretty easily. That's usually where you see the closings happens, when an allocator has to have something and goes after it. What I see less of is, where sellers say, okay, you twisted my arm and I'm going to sell it to you. They will usually just wait. They will sit on the sidelines and try to get something that closer matches what they want, and that's tough. That's really tough.
Yeah, and it's very interesting to see kind of what's happening. So I appreciate you kind of emphasizing that a little bit. So I want to talk a little bit about more of the founder side of things. Obviously a lot of individuals are raising capital. A lot of individuals are sitting there just kind of decreasing their expenses, having a longer runway, expanding that out to like 2025, I've heard, for some of these startups. However, though, at the end of the day, you may or may not need more capital at some point. Because of the macroeconomy, you and I see it, you're on track of it quite a bit. Do you feel like right now, because of the macroeconomy, a lot of things are just kind of on hold in regards to deployment capital and raising capital? And do you feel like at some point you're just going to have to, these founders will just have to experience and just, work with what they have, and then restart the raising capital focus later on, or when the time is kind of more accurate? And when do you think that timeline will be? I know it's all speculative, but I'd love to get your opinion on that.
I'm just giving you doom and gloom today. I'm so sorry, Christian. I do think founders are in for a reckoning this year and perhaps into next year. I do think VCs are deploying less into new relationships, new companies. They're preferring to keep their money and reinvest it in existing portfolio deals. For the reasons I stated earlier, I think earlier stage companies are just going to have a tougher time attracting new capital. And I think with rising interest rates, rising input costs, that's going to lead to a bit of a washout in a lot of the founders out there who are depending on that, depending on fresh money to go to the next round. And so I unfortunately, I do think that space is going to get squeezed a little bit in the next 6 to 12 months.
Mm-hmm. Yeah, and I definitely see it, so I appreciate that. I want to talk a little bit about you in this business and capital raising and law and facilitating these conversations. It really comes down to the one key word of relationships, mm-hmm. right? You are very, very good at this, and really keeping those relationships, establishing it, and making sure, like you mentioned, optimizing everybody's time in regards to the deal versus the founder, and making sure you make the right intros between the investor and the founder, and vice versa, and even obviously your services as a lawyer. What is your secret? What do you do on a daily, weekly, monthly basis to keep those relationships live, even though you may not be doing a deal now, but keeping those relationships, that community, that conversation alive, as well as those just being able to keep those relationships definitely at a macroeconomy when a lot of people are just sitting on the sideline right now?
It's an ongoing process. Relationships take time. It starts from a position of I see you. I see what you're doing. I want to learn about what's important to you. I want to learn what your pain points are, especially if you've used a cap intro specialist in the past. What happened? What went wrong? How can I address that? To my earlier point, I think that because I come from a traditionally fiduciary environment as a lawyer, where it's my job to put a client's interest before my own, I carry a lot of those same principles over to when I'm working with high net worths and family offices, which is to say, look, I want to make sure that I'm helping you. I'm not here to sell you something. I'm here to understand what your needs are. I'm here to understand what your pain points are. I'm here to understand where you're going to be or where you're trying to be in the next 5, 10, 15 years, and how can I put products or services in front of you that make the most sense for that. That's how you start the relationship, and then thereafter it is multiple points of contact, whether they be calls or emails. Miami, as you can imagine, is a very social climate, especially now that the pandemic restrictions have gone away. People are out at nightclubs, restaurants, conferences, and because of the great weather down here, people want to be out, they want to be talking, and they want to be socializing. And that's how you stay in touch. The other way to do this is through being a thought leader in your space. And we all do that to some extent, but whether it's LinkedIn or whether it's articles for industry rags, whether it's speaking on panels, I'm on the leadership team for the Hedge Fund Association, and I work with family offices in that capacity. Programming events that matter to the community of folks that you're working with really sets you aside. It lets people know that you're serious about what you do, that you have valuable content for them, and that, quite frankly, that you're still alive. So many people have gone underground these last couple of years. So it's a combination of all of those things. And even still, because I have 2 jobs, it can be difficult to find the time to properly allocate to building, client development and business development. But it's something that, I have to make sure I reserve time for to do on a day-to-day, week-to-week basis.
Well, what I found interesting is because you have that kind of legal aspect in the law services, that's kind of a good open door or good service. And then obviously on the back end, you can, offer the alternative investing strategies. So that's why I thought it was such a cool bridge, and that's why I wanted to talk about it.
Yeah.
But do you do other outside, like you just mentioned, business development? And you and I know, family offices get pitched all the time. So it's like you can't, cold email them or you can't cold call, right? You got to be different, definitely in today's world where you actually have a lot of content and a lot of availability. A lot of these individuals have social media. They're on social media. They're pushing out their stuff. They have their content, whether it's their company, their managing partner, or whether whoever it is, right? You have some sort of context around who you're targeting. So how do you approach that business development, not in a sales pitch, but like you just mentioned, to build a relationship, to add value, and to ensure that you stand out above everyone else that's obviously like, hey, family office, do you want to write a $2 million check to XYZ? And you don't know who I am, but you don't know who this founder is, but here, I got the best deal in the world, And we see that all the time. So how do you make yourself stand out drastically?
Sure. A couple of ways, and this may sound kind of elementary, but I will state it. The fact that I am FINRA licensed goes a long way, especially in this part of the world where traditionally a lot of private alternative asset deals have been done kind of under the table, relying on friends and finders and folks who perhaps weren't above board. That's starting to change in Miami with the influx of capital coming from other parts of the country. The ecosystem down here is rounding out nicely and will continue to grow. And I think that's really started to distinguish what I do from a lot of other traditional finders down here, which is to say, I am FINRA licensed. I have a Series 7 and 63, so I understand what it means to market and sell a private placement interest to someone. That helps a lot. I think after that, the combination of Princeton undergrad, Harvard Law School, plus years on Wall Street working with institutional and mid-market sponsors and clients really shows people like, look, this is not a game. This is not a game. I hold myself to a higher standard. I understand the issues that institutional level investors require in their documents, and I can produce those for you. I think that really distinguishes me quite a bit. After that, it is a matter of again, having multiple points of contact with people and giving them little pieces of freebies that you can. Obviously, I have to be mindful of how I spend my time and what I can do. But for example, I will prepare a little bullet point list of top 5 things you should be thinking about in this market, or best tips for selecting legal counsel if I'm working with someone that I'm not representing on a legal basis. Trends that I'm seeing in either the legal marketplace or the cap intro marketplace, and that's something that can be prepared in an hour or two, that can be distributed and can really show people that you're thinking about things that matter to them, and that you're trying to put stuff in front of them that's important. The other thing I will say, and I mentioned the Hedge Fund Association work, I will invite folks to events. Hey, come to an HFA event. We're doing a networking event. We're doing an education webinar, or we'd like you to speak on one of those things. Put someone from your team. You'll get visibility, and you'll get to be in front of a group of folks who you might end up wanting to do a deal with. And so I have put together events with that purpose in mind, is to bring together current or potential clients so that they can meet each other and do business. And that those kind of links and associations are very strong once they're established.
Yeah, and it's so interesting. I went to one, I'm so glad you mentioned this. I went to one investor group, and it wasn't that relational aspect. It was very pitch deal-y, and that's fine. But it's also don't brand it like it's going to be a relational aspect. So that's why I think it's cool what you just mentioned in regards to just adding value to your ecosystem, your community, your network, in so many different capacities. And because you have that other vertical in regards to legal and law, you have such amount of great services that you can provide outside of the alternative investing space. So, which is really sweet. When you're looking at those relationships, okay, do you mainly focus only on relationships or family offices or high net worth, ultra high net worth individuals here in the United States, or do you gravitate more toward external, in Canada, as well as, we're seeing a lot pop out of, Saudi Arabia, as well as Middle East and Asia and, Europe and so forth. There's a lot of family offices. Not as many, I was looking, not as many as here in the United States, but there are still plenty amount of in the Europe and Middle East and Asia, and obviously we're seeing a lot of wealth generate and being deployed here in the United States, vice versa as well. So what are you noticing in regards to when you're really targeting? I know you mentioned Miami quite a bit. Maybe you stay in that small ecosystem because everything's coming to you. Maybe that just kind of works out in regards to the way it works out.
I love talking with family offices from anywhere, and I think as just a relationship perspective, having a wide base of folks to exchange best practices with, to expand your network, that's always fantastic. I think because of how the regulations work with regard to where I am licensed to, solicit, you have to be very careful. And so the securities laws allow me to work exclusively in the U.S. without much difficulty, trying to place private placements in outside jurisdictions like Europe or other places. It's a different regulatory environment, and therefore those aren't always going to be easy or even possible. Luckily and thankfully, the U.S. has a very robust family office market. Because of my time in the New York area, I have relationships there, down here in Miami, of course, a few in the Bay Area as well, and Southern California. So I do kind of stay in those major markets. I will say through the HFA and the work that I'm doing with the Family Office Subcommittee there, we are expanding our reach into the Canadian family office market. And I have a colleague there who has really opened my eyes to the possibility of networking with that part of the world and realizing that they don't always get the attention up in Canada that they should. But there is a great market of really talented family office leaders and nice people, as Canadians often are seen as nice, very nice people to work with. So I'm excited about expanding my reach into that part of the world.
That's so cool. And yeah, I got one individual. She's a single family office. She works mainly with female founders. Just real neat. But it was interesting. You sometimes think a lot of family offices get pitched all the time, but some of them don't have the right deal flow. And really creating a funnel and attribution or acquisition channel for a lot of deal flow for that specific thing.
Yes.
So in Canada they don't, and they obviously want to deploy capital. So I'm glad you mentioned that. You mentioned something a while back, and I want to kind of unpack that a little bit further in regards to the deal structure. I've had some individuals like capital raisers where obviously you have the deep relationships, you introduce them to the founder. How involved are you in regards to knowing the founders, maybe like fund, knowing their thesis, knowing everything, so you can pitch it to your Rolodex a little easier and underwrite that a little bit? Not saying that you do the underwriting, but maybe your family office still has to do the underwriting, etc. How active or what role do you play in? It sounds like you take a very active role in it in regards to communication and navigation and getting people lined up. But what is your approach to the actual micro aspect of the deal and negotiations and what that looks like?
Sure. Well, I'm responsible when I take on a mandate from either a fund or a deal sponsor to understand that deal on its face and from multiple angles so that I can present that deal in the best way to the family office or the other investor. And so that's where my legal training comes in really handy, because I can digest the transactional aspects very well, especially if it's a fund. But then it also helps me because I'm able to communicate and distill stuff to the essence of what it needs to be so that I can make a very effective and quick pitch for folks. And so it's my responsibility to know the sponsor and know the deal so that I can, convince my supervising broker dealer that yes, this is worth putting on your platform. And then I need to be able to present that not only to the investors, but I also need to present it to my colleagues at the broker dealer. I mean, I'm blessed to work at a broker dealer where we have a number of reps just like me who are pursuing their own deals, but who are very willing and able to collaborate on the deals that I bring. So and that just increases the Rolodex that's available for any particular deal. And so it's important that I be able to talk intelligently about that deal, and not just on its face, but there might be multiple audiences for this deal. This could be a straight opportunistic play. This could have elements in like a lot of real estate deals do, of a cash flow, kind of like a dividend cash flow. If you look at it, it could be an ESG play that's masquerading as a regular private equity deal. And so being able to tell the story of a particular deal in multiple ways and multiple angles just increases the audiences that are available for that particular deal. And so for those reasons, it's really important that I try to understand the deal as best as I can and be able to communicate that succinctly and powerfully to the family offices and high net worths that I talk to.
So it's a cool approach. So correct me if I'm wrong. Kind of what you do is you reach out to your Rolodex of individuals that are looking to deploy capital, and you say, hey, what are you looking for? Oh, cool. You're looking for ESG, impact investing, specifically in the industrial space. Cool, wonderful. Let's go ahead and gravitate toward that. You find some deal flow that aligns with their thesis. Then you come over here and unpack that slide deck, that investment, whatever it is, and then depending upon that context of, hey, are they more analytical? Are they more kind of bigger picture? Are they more dreamers? Or is it more of like the story itself or the founder? You're able to navigate kind of the pitch deck to align with that, whatever that is. So if they're looking for analytics, if they're looking for KPIs, if they're looking for more of just kind of, like I just mentioned, the bigger, broader picture, you're able to kind of sell that too and say, hey, this is the reason why I'm bringing this over to you, Mr. James, high net worth individual, because guess what? You were looking for this. I've got this guy that's looking for X amount of money, and you guys would be a really synergistic relationship. Correct me if I'm wrong, but that's kind of, you're very, very micro and very intentional with your approach, with your navigation of the deal and making sure that it obviously converts. Is that correct?
Well, I might adjust that slightly. I mean, the reality is sometimes people don't know what they want until they see it. That's all. It's also a very true thing. And so while an investor may say, I want X, Y, and Z in this deal, okay, well, the reality is most deals won't always have exactly everything that they're looking for. And so what you want to, obviously when you're playing any kind of matchmaker, you want to try and get as many of the traits in common as you can. But there are going to be things that vary from what they want, and that's when you decide whether that's worth putting in front of them or not. And, we are salespeople at the end of the day, so we do want to put things in front of the investor that they may not have thought of before that they might want to continue. And sometimes it's because there's something else in the deal that is worth pursuing, even though they're not getting everything on their list. For example, they may want to participate in a deal that's not typically what they do because they might get transparency rights into underlying portfolio deals, which they can pursue later on. There could be some other kind of strategic relationship that's really important to them. It could be because they want to be seen in a certain space because of dictates coming down from their leadership team or from the regulators. And so they are willing to kind of step outside of their comfort zone a little bit. So it is good to put non-standard deals in front of people from time to time, but there has to be a reason for that. There has to be a justification. And you got to be okay when they say no. And sometimes that no means no, but come back in 6 months and maybe things will be different. So it's you just got to keep going.
It's just marketing, it's at the right time, at the right thing, at the right moment, right?
That's right.
And so I definitely understand on that. And when I was curious a little bit in regards to like the relationships, I want to give our audience a little bit of like the timeline because, even during, when it was easy to raise capital just a few years ago and that whole, bullish market and the bridge and everybody was able to raise capital and scale to $1 billion, unicorn and so forth. Now, obviously, the landscape has changed. It may be like that for a little while, but it doesn't mean that it's impossible. And you said it's obviously coming down to relationships. And you probably, correct me if I'm wrong, some of these individuals, when you bring up a deal, they'll probably say no to probably maybe 90% of them and maybe one, and then take one of those down the pipeline for maybe 3 months, do the underwriting, and then they still say yes or no at the end of the day.
Correct.
Just give us a little bit of kind of the timeline for our audience, for those that one, they want to get into it, or two, they obviously have, being able to facilitate that. Because I just think it's really good for our audience and myself to understand how that looks like, in the timeline of it.
Yeah, yeah. Yeah, I think what you're saying is right. I think one of the best pieces of advice I ever got from a former colleague was, with respect to his particular raise that I was helping on, he said, look, let's get to a yes or no very quickly. Explain the deal very well, be assertive about why you think it's right for them. But let's not spend a lot of time convincing them why they should be in it if they're not ready for it. Okay, so because we have a lot of folks to talk to, and as I said earlier, it may not be a right fit now, but perhaps later. But let's get to that decision, that up or down, as quickly as we can. That's kind of like the first timeline is getting to that, and then if they're like a maybe or maybe yes kind of space. Then what you're really looking at is, I try to ask them, okay, well, what does your review process look like? Who's on the committee, the internal review committee, and when do you meet? How long does that take? And people are all over the place. It depends on how they're structured. And so for some people who are nimble, it could be, oh, we meet every week, and we can look at this next week. For some other people who are more institutional, it might be, well, we'll have an initial team review it, now, and if they feel free, they'll pump it up to the boss, who then has to send it to the investment committee. And at that point, you're looking at, okay, this might be next month before we can say yes or no. And so it really does depend on how your investor is internally reviewing things. And to your point, for every 10 deals that make it through the first cut, one or two might make it through the next cut, and only one may make it to the cut after that. And so I think it really does behoove all of us to set realistic expectations with our clients and say, look, it's a bit of a black box. I will try and get updates as I can. And let's get you a meeting. If nothing else, get you a meeting with someone so that they can see you, as a real person, and you can articulate exactly what you're trying to do and how this product or this fund works. And let's see what we can do. But I think realistically for funds, you're looking at an 18, 24 month cycle to get a closing. And on a VC deal, you're probably looking at something like, if not that long, probably 9 or 12 months perhaps. These rounds are being done every year and a half at this point. So you might be looking at something like 6 to 9 to 12 months for that kind of a closing. So it's not easy. It's not easy, but I think increasingly investors understand that they're not naive. I think I think clients, the issuers, understand that they're not naive, and they're not thinking that this is going to be something that's wrapped up in a couple of months. It's going to take time.
Mm-hmm. Yeah, I had one individual. It almost took them, I think, 15 months. It was a startup to bring up about $1 million, and at some point they just had to do a crowdsourcing for just accredited investors, for individuals that were like, hey, let's spend $20,000, $30,000 just to be able to get that number. So it is a very interesting market, and you got to, like you mentioned, just got to go through the numbers. I think, Jeff Bezos talks about how he talked to almost like 300, 400 individuals in regards to the VC space just to raise capital. So I appreciate that. You did mention something, and before I let you go and close up here, I want to ask you about this, because a lot of multifamily offices, and they're very institutional in their approach in regards to, hey, you know what, you maybe have a managing partner, you may have a chief investment officer, but they may be the face of the company, that you might have underneath them a review team, a review board, an investment team that kind of actually filters the fund itself. I'm curious, Jamil, how do you approach that? How involved are you in regards to, hey, I'm talking to CIO, but I also want to pitch it to the investment team, right? Because it is a sales, right? You got to explain it to them a little bit, and how this could be a synergistic relationship between the multifamily office or that high net worth individual, or vice versa, whatever it is. How do you try to kind of integrate yourself into their institutional process? And institutional, they do it for a reason, and I definitely understand, to mitigate their risk and so forth, and et cetera, et cetera. So I definitely understand. But you do have to learn how to navigate those institutional kind of investment criteria.
That is a very difficult thing to do if there's no pre-existing relationship with the institution. They are structured that way, as you say, for a reason, and they can be labyrinthine and very hard to penetrate, to be very honest. I have found that when I'm talking with larger family offices, multifamily offices, or institutions, I'm a bit at their mercy in terms of how to get in on the ground floor, unless I know someone there. And so when I do talk to those sized firms, I try to have a relationship one way or the other, whether it's, this is someone I went to law school or college with who's now ascended up the ranks and is now in a position to help me get into the organization, or I will find someone who I know who does and work that first degree relationship to get there. And that usually means, and even then, that can usually mean, okay, well, you may not be able to pitch directly to the CIO at this time, but his or her number two is available. His or her number two will look at it and then opine. And as you know, I mean, look, the name of the game is no one in these institutions wants to put forth a bad deal. They're trying to make their way up the ladder as well, and they can't be seen to be forwarding up, stinkers up to their bosses. It's just not going to be a good look. So there's not always an incentive to be liberal, so to speak, on these deals. There's an incentive to be very conservative on these deals, actually. But again, like having pre-existing relationships, either directly or one degree removed, really can help me kind of target, okay, here's the CIO, he and I went to college together, or, she lives down the street in Coral Gables, let's try that way. And if not, then let me speak to his or her number two and talk to that person and figure out what the number one person is really caring about these days, whether it's returns, whether it's downside risk or allocation within their whole portfolio, reputational risk, mandates from head office, whatever it is. Let me figure out what the number one person really cares the most about and try to angle my pitch accordingly.
Such good insight, man. Jamil, I really appreciate you unpacking that, because I was talking literally just maybe a week ago, a multifamily office. And I just sent him something. I said, hey, I know we know each other, but, I want you to just, look at this. And he says, well, we don't actually take outside of things, and I don't circumvent my, investment team. And we actually, establish a really good relationship with another organization that actually gives us deals, specific deals that we're looking for. So they already had a very well established thing. I said, hey, no worries, cool, awesome. And I just wanted to ask that on a personal basis, but I think it's also very good for founders or for all sorts of individuals that are looking to raise capital, regardless of what vertical, and really how to navigate that. Is it worth the time? Is it not? I do know that those individuals can write bigger checks, institutions, so you got to just play their game, like you said, they're at their mercy. Jamil, man, I appreciate this conversation today. This has been a lot of fun. And before I let you go, I want to ask you, first of all, how can they reach out to you? For those that are like listening to our podcast that are like, hey, we're looking to raise that next level. We got some secondaries. I'm looking to sell, whatever it is, right? Whatever the case is, how do they reach out to you? How do they have that conversation? Who you're looking for, making sure that you're optimizing their time and your time?
Sure. Like most professionals, I'm on LinkedIn. And so that's always the best place to find me. I have a description of both sides of my businesses, and you can see from the resume what I've done. I would also say you can reach me at archeinvestmentsgroup.com. That's ARCHE investments plural group.com. It's a website that services my cap intro businesses. And you can find more information about the services that I do, and there's a bio on me as well. And so Stonehaven Group, which is the supervising broker dealer for Arch, has a profile on me there. You can reach me at stonehaven-llc.com. And then FisherBroyles LLP, the law firm where I work, also has a bio on my services and my resume there, and that's FisherBroyles.com. So I encourage everyone, get in touch. Let's have a conversation, whether your legal or cap intro needs are now or down the road. It's always important to talk about what's important to you so that we can figure out how to be of service to folks who are looking to start or fund cap intro investments.
Awesome. And guys, just to make it easy, all those links that he just mentioned, I'll put them down in the description. You just click on it, open that up, be able to have that conversation, network with him. He's very, active on LinkedIn, and then also on his website as well. There's a contact information there. So make it easy for you guys, just be able to reach out and connect. Highly would recommend it. Even having that conversation, like Jamil said, if it's 6 months or 8 months, you got to kind of, skate to where the puck is going. Have those conversations now, have that dialogue now, and start that journey before you actually start the whole campaign. So, Jamil, I really appreciate you being on here. I always love to ask my guests before I let you go fully one last question, and it's more personal. So if you can visualize and imagine your young self, okay, and what insecurities did you have to overcome to become the successful Jamil French you are currently?
Wow, I didn't know, Christian, it was going to become an analyst session. But look, I think growing up where I did, I didn't see a lot of people who looked like me who were doing the kind of things that I wanted to do. And so, for I would say most of my childhood years up until about the age of 16, I hadn't really thought much about how I could be something different than what I was. I had the great fortune of doing a 7-week intensive homestay in France between junior year and senior year in high school. And it was my first time traveling abroad, and it really opened my mind to the world of things that are possible, things that I didn't see for myself before then. And when I came back from that homestay, it really changed everything. And it led to me applying to Ivy League schools. That was a new one for my family. And it also just really set me on a path of thinking about things that are outside of my comfort zone, that could take me in new directions. And so, if anything, I would tell myself, look, if you want to get to that next place, you might have to do some things that are outside your comfort zone. You might have to stretch yourself in different ways so that you can be the best person that you can be, not only for yourself, but for the people that you care about in your life. And so, by all means, all of us need to get a little uncomfortable, do things that we're not used to, stretch ourselves so that we can be of better service to everyone else.
Well said, man. Well said. Guys, that is incredible wisdom from my friend, the CEO of Arche Investments, the one and only Jamil French. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Thanks so much.